if the dollar is rising or not between that point, and it's certainly seen it hitting 2002 levels of high levels. So we would expect the commercials to ring the register on these bets.
There seems to be quite an imbalance here. And I guess the question is, in the short term, where does this imbalance, where is it likely to play out?
Yeah, so very short term, because we have options, and then we have September expiry and of silver. The December contracts already trading in gold. So what's happened is the insiders have been hoodwinked into thinking that they could short sell the options $20 calls. So in other words, what they've done is bet against it being closed at that level. So, but the house is on the long side of this. So really dependent on the crosses. So if you see a weaker dollar or a stronger dollar, obviously that is going to influence the short-term action, but it's coiling a spring regardless. But obviously, as we go into Jackson Hole on Friday, what it's doing is driving automated selling and buying. So really, it depends very much if the dollar is rising or not between that point, and it's certainly seen it hitting 2002 levels of high levels. So we would expect the commercials to ring the register on these bets because they are on the long side of these speculator short bets. But on the other hand, what they may do and have done in the past is allow them to roll, because these speculators are that blind to the physical markets that they usually, when they come into the money, i.e. they can cash out, instead of taking the money, what they do is roll these bets into a short bet and then wait until the last minute to roll out. And we've just said, here's the problem. December doesn't make sense to them because it's just below the price of cash. So this is an unusual situation. But in gold, same question really. Massive physical support is at the equivalent 1800 spot level. Now, that is obviously, that is counter to what the action we're seeing now, because currently that's about 1812.50 futures because of the carry costs. But again, you can just bet you're going to see these guys to completely rinse the speculator bets, and it's probably by way of an air pocket that they will, when it comes to rollover, nobody's going to take delivery in the COMEX. And so what you can do is you can create these air pockets where you literally know their positions, you start pulling some bids. So we would expect that to rise. But as we've recently been observing, though, there's a strong competing central bank amongst all of this, strong competing central bank and sovereign size physical buyers ready to step in to capitalize on these synthetic discounts. And they are, which is the only thing providing any form of discipline at all to the non-delivery COMEX pricing mechanism. So ultimately, paper prices are convertible into physical through the EFP mechanism. And it's this unwanted competing physical demand that is forcing commercials exposed to the physical market to buy back futures to hedge physical exposure. So I guess the bottom line of this is just how long can this divergent action continue? And really, if we want to look at the answer for that, you just got to take off the US-centric blinkers designed to block these COMEX participants from ever taking the larger 360 view, which to every other participant is telegraphing fair value prices that are significantly higher than currently what's on offer in the non-delivery world of the COMEX casino. So by design, the global view is hidden from the myopic COMEX participants, yet under the US-centric radar, a large unleveraged move into physical gold from all other participants, and I mean all other participants, is underway. This includes the same market-making banks operating as official agents in the COMEX marketplace to also load up on physical based upon these massively divergent prices. So this fresh move into physical gold and silver is driven by the largest, and in gold particularly, by the largest foreign central bank move into gold since Nixon closed the gold window in 1971. I think people just aren't getting that. And these reported foreign central bank and sovereigns are moving to diversify their reserves away from the dollar. And in doing so, they've effectively reopened the gold convertibility window by competitively moving in against each other to load up on a gold price that in their view is hundreds of dollars below where they perceive it is worth against the dollar. Yet when we look at the published data, it only reflects the volumes that must be reported, which although is way short of reflecting the real picture, already evidences the largest move by competing central banks into gold since 1971. So that's just what can be visibly seen. So China and Russia are really the elephants inside this synthetic price setting room. However, the emerging market central banks have now moved to become some of the largest buyers of gold. And also lagging reports of strong Indian wholesale buying, which we talked about last time. Still, they're starting to leach out, but they're not really discussed. And of course, this doesn't affect the close to 90 tons we talked about of smuggle gold per month, feeding this oil the gold for oil trade. And none of this data captures monetary gold escaping the reporting mechanisms, nor are direct imports from foreign-owned mines reported, all of which contributes to really tightening supply at current dilutive non-delivery prices. And it's the offer to sell real physical that is rising, and it is the attack on paper gold that is draining the necessary liquidity to suck in enough spec supply to offset this move. For alchemists, because this is what's going on, these guys are alchemists converting paper gold into physical, and they're thinking anything sub 2000 is huge value. And in other words, they're looking at backwardated pricing now. And given the size of the move into physical, and with physical gold priced synthetically at the margin, each ounce removed from the COMEX price setting mechanism weakens the official mechanism to further control gold pricing. Now, what we're witnessing is an unprecedented move to secure and really lock in gold at a fraction of what really it is worth. And if you remember, if we look at, you remember we talked about the LBMA coming out, and they were talking about they admitted in their I think it was the issue 990 of their LBMA program. They admitted, yes, the wholesale physical markets are broken due to, quote, ebbing liquidity. Hey guys, now this is becoming real. I mean, the LBMA were already telegraphing what we're now witnessing, which is a broken but increasingly arbitrage paper market, which when it lands as an EFP in the hands of the over-the-counter liquidity provider must now be Basel III NSFR compliant and physically deliverable. Only the depleting GLD inflows, and they are depleting because when you've got this kind of negative sentiment, then, even these guys who are buying GLD when they feel bullish are not entering into those trades, which is actually helpful for us. But even then, GLD is receiving, GLD is really less of an issue now because there's less to flywheel into there. And so I guess what we're saying is the newly weaponized dollar is incentivizing central bank and sovereign physical demand and repatriations. And while the formation of the BRICS currency basket, trade wars, negative interest rates, comparative bubble territory risk sentiment, pushing up against undeliverable bubble territory short gold and silver positions, there are reasons enough to take the gloves off anyway. And the gold and silver price reset clearly under the radar of this absolute bastardized action that we're seeing is undoubtedly not far away. And this is not the time, certainly, to be short safe havens of any kind, let alone gold. So this leads perfectly into the Russian Finance Ministry announced its plan to create its own international standard for precious metals market. And as we say, it's called the MWS, and it will become a competing alternative to the LBMA. And as I say, not just about purity and provenance. This is going to set a benchmark price outside of this LBMA cesspit. And Basel III is all well and good, but we're seeing COMEX gold EFP'd into this Basel III compliant over-the-counter market. But the non-compliant GLD flywheel is still infested with, even though it's reduced, it's infested with siloed COMEX-centric paper market actors who continue to unload their positions from that side of things. Some are neutral, but some are predatory.